How's it going, everybody? You ever have one of those days where just nothing seems to work and you have a lot of bad news? Well, I'm not going to put that on you guys. Welcome to the Closing Beat recorded edition because the upload speeds here have drastically decreased in the entire area. So it's funny how there's no way to know that until you hit the stream button and you go, wait a minute, what happened? Anyways, I want to cover the markets real briefly here. We're financial advisors at Jazz Wealth. Struggling with our upload speeds today, but I want to talk about the markets because a lot of interesting things happened today. So if you've been participating, then you know that the Fed raised interest rates today by a quarter of a point. And why is that important? Why would the market, if you look over here, why would the market sell off so aggressively going into the close? Well, think about what just happened. The Fed removed the word accommodative from their speech, which means that's the official end of easy money. They're basically telling you, that's it. Easy money is done. We are going to start raising rates on our path, really regardless of what happens, unless there's a major catastrophe. So that's it. People know easy money is over. Now, why would the markets fall? Think about it. If you're a longer-term investor, we're longer-term investors here at Jazz Wealth, and what happens is all these companies, you got like a Chipotle, all the big companies that took debt over the last few years, very smartly so, by the way. Those of you that are anti-debt, you kind of missed your opportunity, right? All these big companies took on debt to grow their businesses, and in the next few years, they're going to make good on that debt. What happens then? If things are good, they may take on more debt to further grow their business. If things are bad, they may try to find debt to help support their business. All the big companies out there. Well, what happens is if later in the next couple years, the 10 years trading at 4.5, maybe 4 3/4, something like that, then when they go to collect more debt or absorb more debt, it's going to cost them more. The process to service that debt's going to cost more. And so what happens is it eats into their profit margins. And so you run into this thing where we started saying yesterday and the day before, or the last week, you really want to consider how you're invested right now, not because the markets are going to crash, but because it becomes wise to spread out your investments. We're doing this tomorrow for our customers. I've already sent out the email on how we would like to adjust our customers' portfolios to go wide. Please do not look at what the markets did today. Do not look at the historical statistics. Do not look at the long-term stats of September and what's happening now and go, oh no, the markets fell a tiny little bit today, and freak out and go to cash. Going to cash is what all the novices do. Going wider is what all of the money managers do, is what all of the fund managers do, is what all the target date funds do. They go wider. And so with our customers, we have our portfolios on our website, and now we're saying we want to go wider. Because imagine what I gave you the other day. The market is like a juggler spinning the plates on the sticks, right? And all the plates were spinning just fine. And so now what's happened is the plates are starting to wiggle, a little over here, a little over here. And so investors are moving away from the wiggling plate, and then they're moving away from those, and they're sort of shifting around. That's why you see the sectors doing what they're doing. Healthcare being one of them, consumer discretionary being another one, consumer staples being one of them. You see people moving around sector to sector. Well, if you're invested sort of focused, even diversified, but still in a focused way, then you run the chance of taking a greater hit. So we're going to go over all of that for our customers tomorrow. I hope everything is fine with the upload speeds by then. If not, I'll simply make a video for you guys. But that is basically what's going on in the markets today. You got the Fed making their adjustments. They removed accommodative from it. And because of that, you can see the Dow was lower on the day by 106 points. You got the S&P down a total of 9 and the Nasdaq down 17. So that's really the focus here, is what happens regarding people taking on debt, companies taking on debt, and how will that affect the stock market going forward. Let me see if I can shift over here real quick. All of this seems to be working just fine. So here's the Dow down 106, no problem there. S&P pulling back, still very much in the midst of an uptrend. Notice nobody's calling a top in the market. No need to say that. My sort of fun prediction was, hey, I'll bet you what we saw on Friday was the top of the market for September, given the stats. Now, I hope I'm wrong, of course, but all signs seem to point to that. So you've got all this stuff going on today. I want to focus more on making sure you're spreading out, you're investing in a wide fashion and not so much interested in the individual stocks. If we look at the individual sectors, your new communication services sector did okay. It did close off the highs today, but not really anything to worry about. And we mentioned healthcare just a minute ago. That could be a more significant short-term topping sort of pattern there for that one. We're not short-term investors here, by the way. I just like pointing out this sort of stuff on the charts to give you sort of the heartbeat of the overall market. So the healthcare sector was pretty strong. Here's the banks. The banks closed back down below the 200-day moving average. Banks were the big sell-off today and have come back into that range. Sort of unfortunate because they were just starting to get something done there. Banks, of course, participating greatly in the interest rates there. They also taking on debt themselves. Banks have been rapidly trying to grow. And now that we know the more clear trajectory of interest rates, you kind of saw, of course, the weakness in those. I'll just highlight a few names in the stock market today. Nike down 1.29%. Not really a big deal there. They reported earnings and revenue. Wasn't exactly what everybody was hoping for. Profit targets, profit margins were some of the issues there. KB Homes, one of the home builders. Look, they didn't have. I mean, they didn't do too bad earnings-wise. They reported earnings, but they're really struggling with higher costs. Higher labor costs, higher material costs, now higher interest rates, and we all know higher interest rates. So, how's that going to affect new home sales? And actually, new home sales did come out today. Am I getting my days blended together? New home sales are slowing, right? So they did beat by just a little bit, but overall starting to slow, and that hurt KB Homes. So that was something that stuck out in the news. If we go look at SurveyMonkey. That's the actual name of the company. SurveyMonkey is, you probably heard of them. It's an online company, does surveys, but they had a really successful IPO, although it doesn't look like much on the chart there. They did increase their initial price, their offering price to $12. They increased the number of shares they were offering, and investors soaked it up. So it was a successful IPO. I think the underwriters would feel like maybe they left a little bit on the table there, but no problem. Overall, a successful IPO. Bed Bath & Beyond, symbol BBBY, reported earnings. They missed after the close here, missed on earnings and revenue, so a little bit weaker there. But hey, the moral of the story today is to make sure you're invested the way you're supposed to be for the next couple of years. If you're a long-term investor, then and you're one of our customers, you don't want to miss this class tomorrow. I'll probably honestly just make it a really short video. If we're having internet issues or something, I'll probably make the video ahead of time just in case. But the plan is to do a live class to help you out with that. If there's anything I can do for you, you know where to find me. I appreciate your patience, and still just wanted to get this video out to you, so I'll wrap it up there. And let me know if you have any questions. Talk to you later.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.